Now we're going to pivot into Europe, and we want to talk about some of the European issues, and it's because a lot of the things that are happening in the U.S. are also happening in Europe and obviously around the world. But it's looking more along the lines of developed versus developed, because this is where we can see some of the expectations, some of the things that are coming, down the pike. And I think it's important to look at, the ZEW Eurozone expectations of economic growth. So you can see that it's normalized. It's come back down. It's still expanding, but you see that it's starting to come under pressure because, again, all of this is showing that things are getting better, but maybe not as good as they were. And that's where we're starting to see some of these pivots with some of the issues out of China, some of the issues out of Asia, some of the problems that have continued to arise that, again, are leaving some of these pressure points really exasperated, if you will, when you look at what does that economic growth look like. And another reason why, when you look at Germany, France, Spain, things are a little bit less than perfect. But when you look at Italy, things are going great. So again, as much as we talk about these things, Italy still remains robust. But when you look at it on an aggregated level on what drives the Eurozone, Italy weighs much less, which is why we still see some of these pressure points. And what we talked about really, about 3 months ago, when we kept saying, look, Germany's slowing, and that's going to be a problem and an overhang. Not that it was slowing in the sense where it was going into a recession. It was just not doing what it was supposed to. And I should say, wasn't doing what expectations dictated. And that's where we continue to see some of this slowdown in general as we go forward. And the other side of the equation, the Eurozone, is the inflation continues to surprise to the upside. So we keep seeing, not just in the U.S., but inflation surprising higher within the Eurozone as an aggregate, again, which is causing some of these overall problems, which becomes the underlying of, okay, well, what does this mean? How do we deal with this? And right now, the ECB is like, look, steady as she goes. We want to get to our inflation target. So we're surprising to the upside, but we're still within a comfort range of where we want to be, versus in the U.S., we're already above where we want to be, or where the target is of 2%. So when we look at Germany, this is just going to look at some of the backdrops. So factory orders were expected at 2%, came in at 4.1%. Again, positive. Market German construction PMI, though, came in again at a contractionary level of 47.1%. So construction still remains this big overhang within Germany, where we're just not seeing the activity. So factory orders are up, but industrial production is down. So, and then remember when we were showing all the different charts over the last couple of weeks, where we just saw the in production falling and weakening. So you're still getting the orders, but you're still facing those assembly line issues, those timing delays, those overarching problems that is resulting in industrial production falling. So orders are climbing. Industrial production was expected at 0.5, came in at negative 1.3%. But it also means that there's support for Germany. So even if we see some accelerated slowdowns, there's a lot of orders sitting on their books that will help solidify and help protect from things getting too bad. And that's where we continue to see Germany as kind of this in-between. Now, exports were up 1.3% versus the expected of 0.3%. And if you look at factory orders, they should still remain elevated because it's still an exporting industry. It's still an exporting economy. So you're seeing some of that benefit that's going to come through, but imports are slowing. So imports were expected at 0.4, came in at 0.6. But imports being so far below exports, again, you're seeing that pressure when you're looking at, well, if imports are coming in, that means they're not importing raw materials that they need. They might not be importing the semi-finished goods. And that, again, leads back to the industrial production problem, which is where we continue to see some of this overhang on economic growth, which is showing up in some of these surveys. So the ZEW survey expectations were at 55. Came in at 40.4. Current situation was expected at 31, came in at 29.3. So expectations have worsened versus prior, but current situation has worsened versus estimates, but still better versus the previous. So that's where you start, like people are seeing this saying, look, we're in an okay spot. We're not great, but we're in an okay spot. And there's looking at those orders, looking at exports, there's going to be some light at the end of the tunnel as we progress. And when you look at services are recovering, while manufacturing is those. So again, the services are, and similar to what we're seeing in the U.S., services are getting a bit better, but that manufacturing comes into those headwinds coming back to that supply chain, and it's really not stopping. Because when you look at Germany truck toll miles, then you look at Germany, France, Italy, Spain visitors to retail and recreation locations, you're starting to see there's some of that balancing. You're starting to flatline a bit, and when you go back to last year, you're similar in terms of positioning. But again, you're starting to see some of that pressure on the toll miles, which is why when you look at factory orders here and then industrial production, that you're seeing that bifurcation, which you're going to meet somewhere in the middle. And the German value of monthly car output is continuing to come under pressure. This comes back to chips. This comes back to think about BMW, Audi, Mercedes, Volkswagen. A lot of these big car brands come from Germany, and here's where you're just seeing some of those additional pressure points on the value of monthly car output, industrial production in motor vehicles continuing to come lower. They'd love to capture the higher price and fill the market with the demand, but again, you still need chips, you still need parts to do that, and that's where they continue to struggle. And then when you look at just the general level of German industrial production, here you can see just the production at construction energy continuing to worsen within Germany itself. But now when we turn to France, so industrial production in line with estimates, but manufacturing production missed estimates. So it was expected to be at 1.4%, came in at 0.9%. So when you look at the trade balance overall, again, you're starting to see some of these pivots where private sector payroll, surprise to the upside, was expected at 0.6, came in at 1.2%, but wages prior were at 0.6, now at 0.3. So you're starting to see some of this pivot. But when you look at France, the way France has been operating, it's been very steady. You know, it's a little bit below estimates, but not by much, or right at estimates, where Germany is a little bit more below estimates and Italy's, above estimates, while Spain kind of falls within a weird kind of parameter, give or take. So then when you look at Spain, industrial output was expected year over year at 13.5%, came in at 11.1%. So when you look at industrial production month over month, was expected at 0.5, came in at negative 1%. So Spain continues to see that deceleration. But then on the Italian side, industrial production was expected at 1.1%, came in at 1%. Slight miss, but still very much in line and much closer. When you look at the other countries, they've all had negative industrial production. Italy's had positive. So when you look at France had, was positive, but at 0.5%. So Italy has seen a bit more of that additional growth, which is supporting some of these movements, which is why when we look at trade, what has happened in general, we want to look at what are some of the opportunities that Europe will have. And we'll talk about that when we get some more data as they come out next week. But when we look at Brazil, just putting this into context, because when you look at Brazil, headline inflation continues to explode well above what the target is, and that's what that dotted line is. So core inflation is up, headline inflation is up, and this is where when we look at emerging markets being in a rate rising cycle is where we see some of these pressure points, which we're going to talk about in more detail as we go through Asia in more detail, because it's something that is playing out across not just Brazil, but also in other emerging markets, which we think is going to become a much bigger headwind as we move forward to talking about not only just Europe, but also more importantly, emerging markets and where that growth profile is, leading to inflation, food security, wages. Emerging markets are going to be hit the hardest when we look at some of these near-term backdrops. But now in the next segment, we pivot to Asia, our favorite longer topic that we like to talk about in more detail.